Hello financial fans, welcome back to another stock analysis. Today we'll be covering VF Corporation, stock ticker VFC. VF Corporation is an American multinational clothing and footwear company that designs, manufactures and sells a variety of apparel and footwear products. The company's portfolio of brands includes Vans, The North Face, Timberland, Wrangler, Lee and Nautica. VF operates in multiple segments including outdoor and action sports, jeanswear and imagewear. Their outdoor and action sports segment is focused on outdoor and active lifestyle apparel and footwear brands. Their jeanswear segment includes brands such as Wrangler and Lee, and the imagewear segment includes uniforms and workwear brands such as Bulwark and Redcap. They also have international operations, and the company's products are sold through a variety of channels, including retail stores, e-commerce sites, and wholesale distribution. Their market cap currently is sitting at $11.89 billion, and in 2021 they generated a revenue of $11.87 billion. Dividend yield is currently 6.55%. 51% of their revenue is generated in the United States, 30% in Europe, 13% in Asia Pacific, and the remaining 6% in the Americas, excluding the USA. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, which can either increase or decrease by the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors in a scale, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from our margin of safety. The first 2 ratios that we're going to look at are the EBIT growth and the margin growth. The EBIT has gone down from $11.4 billion in 2013 to $9.2 billion in 2021. The average growth was minus 5.9%, so a 5% increase in our margin of safety. The margin hasn't done much better, going from 14.4% margin in 2013 to only 7.7% margin in 2021. The margin growth it's supposed to say minus 6.2% here, which is a 5% increase in our margin of safety. The next 2 ratios that we're going to look at are the dividend growth and the payout ratio. The dividends have gone up from 2010 to 2013, but have taken a hit in 2014. The growth has continued in 2014 to 2021, but the dividend growth is unfortunately barely negative at 0.21% in the minus, which means again a 5% increase in our margin of safety. The payout ratio is not looking very good. It's at 85% currently, meaning another 5% increase in our margin of safety. Not going that well, is it? The final 2 ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For VF, this is almost 3 years, so an almost 300% debt to EBITDA ratio, meaning no change in the margin of safety since it's slightly below this. The return on invested capital for VF is sitting at 8.6%, meaning again no change in the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of VF. The first valuation model that we'll be looking at is the discounted cash flow model. I've imported the free cash flow going from 2013 to 2021. The average growth in cash flows during this period was 10.68%. Since we're calculating a lifetime expected growth up until 2030 for VF, I've gone with 40% of this average growth, which is 4.27%. With this percentage, we can determine the future free cash flow for VF up until 2030 and then determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. Out of this, we get a sum of free cash flow of $21.7 billion. To get our equity value, we have to add the debt and subtract the debt. We have to add the cash and subtract the debt, sorry. And out of this, we get an equity value of $16.2 billion. And the last thing we have to do to get our discounted cash flow price per share is divided by the amount of shares, which for VF is 388.5 million shares. Then we're left with a discounted cash flow price per share of $41.68. And with the current price of $30.67, we get an upside of $11.01, which is almost a 36% upside. The second model that we'll be using is the dividend discount model. I've imported the dividend payments going from 4 years ago to the current year. The average growth in dividends during this period was only 2.15%. And since we're once again calculating the lifetime expected growth in dividends, I've gone with 60% of the growth average, which is 1.29%. We'll also be using a discount rate of 8.5% again in this calculation. And out of this model, we get a discounted dividend model price per share of $28.10. And with the current price of $30.67, here we get a downside of $2.57, which is almost an 8.4% downside. The last model that we'll be using is the multiple valuation. In this model, we'll be looking at similar companies to VF and look at their stock price and earnings per share to determine the average PE multiple in the industry that VF operates in. In this case, it's an average PE of 13.85. And all that's left to do to get our fair value here is multiply it by the earnings per share that VF is generating, which is $1.08 per share. Out of this, we get a fair value of only $14.96. And with the current price of once again $30.67, we get a very big downside of $15.71, which is over a 51% downside. Let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, and multiple valuation price per share. Out of this, we get an average of $28.25. Our margin of safety has been determined earlier by using a standard margin of safety of 25%, adding 5% for the EBIT growth, adding 5% for the margin growth, adding another 5% for the dividend growth, and adding another 5% for the payout ratio, leaving us with a huge margin of safety of 45%. Not looking that good. This leaves us with a fair value of only $15.54, and with the current price of $30.67, this leaves us with a massive downside of 49%. If we were to remove the margin of safety, the downside would still be almost 8%. And some of you might want to see the average price when we get rid of the multiple valuation, since it was such a big modifier. Even doing this, we still get a 37% downside. And then, for example, removing a margin of safety, only then we get an upside if we remove a lot of factors. But if we take, again, the full value, the full overview of our valuation, it's a huge downside. So in my case, I would think it's a sell at this point. If there's any other companies that you would like to see me cover on this channel, please let me know. And thanks for watching.